Moving on and continuing with the pharma theme, it's been a rather healthy quarter for Ajanta Pharma. While sales have risen over 12%, profits have surged a whopping 43%.
To discuss the quarter gone by and the road ahead, we're being joined by Yogesh Agrawal, MD at Ajanta Pharma, and my colleague Shraddha Babla is also joining us on this conversation. Hi, Mr. Agrawal. Thanks so much for joining in. Let me start by asking you about this quarter. Margins have been on a declining trend. Can you take us through that part?
So on the EBITDA level, the margins have shrunk by 3% from 36% to 3%. Primarily, it is a result of our higher spend on the R&D. For the whole year, we have spent 106 crores in the R&D. Out of that, 36 crore alone was spent in the last quarter. So if you see our R&D spend for the last quarter alone, it works out to 9%. But for the whole year, it works out to 6%. So the higher spend in the R&D has kind of impacted the EBITDA margins to about 3%. But overall, that was the intent to spend high on the R&D.
Right. So as far as the new facility that's coming up in Gujarat, what are the clearances and approvals that are outstanding? Can you take us through the plan there and how that is progressing?
Absolutely. Our Dahej facility is, in terms of project execution, it is fully complete. We are in the process of taking the validation batches for filing with the regulatory authorities of US FDA and WHO and some other emerging markets. In next 3 months to 4 months, we should be filing these dossiers with the respective regulatory agencies. And I believe that in about 12 months to 18 months, typically it takes 6 to 9 months for the regulatory agencies to come and inspect you after you file the dossier. So anywhere around 12 months to 18 months from here on, I expect we should have the regulatory approvals from the stringent authorities such as US and WHO. But pending that, we are going to commercialize the facility from the 1st of April 2017 for our other emerging markets.
Okay. How do you really see your domestic branded business doing given the ever expanding list of price control or LNEM drugs? What I'm trying to understand is what is your percentage of the portfolio that comes under LNEM drugs?
Interestingly, we have chosen to stay away. As you will know, we operate in the specialty segments. We operate in the ophthalmology, dermatology, cardiology, and recently we added the pain. So we are not there in the major segments of antibacterials, antibiotics, those kind of segments. And the list primarily consists of the products from these segments. Nevertheless, we have about 3 products all in all which have come in this. And for the last year, the impact of this product coming into the NLEM or DPCO has already been factored in. So the impact overall has been very, very negligible on our domestic performance of this product portfolio.
Where do you expect growth to come really from the Indian market? Do you expect it to come from volumes, price hikes, or new launches?
It will be a combination of both, and that has been the traditional history also for us and for any pharma company for that matter. So we are expecting the higher growths to come from the cardiology. Last year also amongst the 3 segments which we operate in, and the fourth one got recently added, pain management. The highest growth was registered in the cardiology segment of over 30%. In the second highest growth was in the ophthalmics, and third was in the dermatology. Pain showed a very, very high growth, but since the base is small, I think that cannot be compared, the growth rates cannot be compared with the growth rates of the other 3 segments. I think the price hike may contribute about a few percent to the growth, but mainly it will be increasing the productivity from our existing medical representatives field and also launch of the new products.
So talking about your foray into US, it hasn't been as quick as expected in terms of accretiveness to revenues as well. I understand there have been 5 products launched till date. By when do you think can it start adding meaningfully to the P&L going ahead?
US has been slightly slow ramp up for us, not for the reasons of our own control. Primarily, we got into the cycle where the US FDA introduced this GDUFA, and the entire old dossiers which were filed ANDAs, they kind of took the back seat. But we have seen the very high level of activity with the FDA, and out of the 10 ANDAs which we have approved, out of that 8 approvals were received during the last 12 months. So we see a high level of activity from in the FDA. We have about 16 more ANDAs awaiting approval. It's very difficult to give the timelines for the approvals, which is not in our hand. But we believe we are at a number of ANDAs are at a very advanced stage of reviews, and if all going well, we should expect some decent number of approvals. And also the ANDAs for which we received the approvals last year, they are at various phases or various stages of launching. So we haven't really seen the full 12 months sales potential, peak potential of these products. So I expect that in next year, that is FY17, US should contribute in some decent way to the sales and profitability of the company.
Okay. How are some of your emerging markets doing given the currency impact there? Are you scaling down in some of the African or the Asian markets, or what is your strategy as far as emerging markets are concerned?
Emerging markets, we are one of the few pharma companies who has such a strong ground presence on the field. We have over 650 medical representatives which are promoting specialty niche products in the various geographies. We continue to remain very aggressive in the market, in the emerging markets as well. In the last 12 months, we've seen the headwinds in terms of currency volatility. There has been devaluations in various countries to the extent of 30% to 100%, and also there has been scarcity of availability of the dollar. So that has kind of impacted our ability to grow in the last 12 months. Despite that, we've posted a robust growth for the whole year. We believe that we should be able to continue to grow in these markets given the strong presence which we have in Asia as well as in the African markets.
Right. So if you could tell us, when was your Aurangabad-based US FDA facility last inspected?
It was about 12 months back, April 2016.
Right. Over the last 5 years, your net sales and PAT have grown at 31% and 57% CAGR. What do you think is a sustainable growth rate over the next year or so?
Indeed, last 5 years, lot of things which we had done that had kind of resulted into the sales and the profitability, and our growth has been quite robust in last 5 years, both in the top line as well as the bottom line. We believe going forward, we are giving a guidance of mid-teens to high teens for the next year. I think beyond that, we don't give guidances beyond the next year. So let's take 1 year at a time. For the next year is what the outlook which we can give.
Right. So there has been some pressure on the margins this time around. R&D costs, I understand, have been at around 9%. Is it likely to go up in terms of R&D expenditure? What are the plans, the outlay committed for R&D going ahead?
R&D in terms of revenue expenditure, we are projecting for the next year, it should stand around 7%. Last quarter, what we spent, about 35 crores, that is what quarterly spend we are expecting on an average for the next 4 quarters. So it should stand around 7%. That is, we've increased the R&D spend. Traditionally, it has been around 5%. Last year, it was 6%, and this year, it should be around 7%. So we have identified a number of good products and good opportunities for various geographies, India, emerging markets, and US. And we believe that the higher spend in the R&D is required. Besides this revenue expenditure of 150 crores next year, we have the plans of spending around 100 crores more in the Capex to invest in the building of the new facilities.
Right. So just taking that point forward, can you take us through what your expansion plans are and also the new formulation facility in Assam?
For the next 12 months, we will be very busy. We have total Capex plans of 500 crores. We are putting up a new facility in Guwahati, a formulations facility, where we will have the 10 years income tax exemption. So we are going to spend about 200 crores in that facility, which we plan to operationalize by March 2017. 100 crores odd will be spent in the Dahej facility, and 100 crores odd will be spent in the R&D. And besides that, there'll be about 100 crores more spent in the routine capex in various facilities which we have. So for the next 12 months, there'll be a capital outlay of about 500 crores.
All right, on that note,
And if I can just add, we have a cash balance of about 50 crores odd plus 50 crores in the investments. So we have about 100 crores plus balance with us. And we believe that all these expansions of 500 crores, we should be able to meet with the internal accruals which we will generate during the year.
Fair enough, Mr. Agrawal. We'll leave it at that for dearth of time. Thank you so much for joining in on the show with the detailed lowdown as to how the quarter has been and the plans going ahead for Ajanta Pharma. Well, on that note, we are completely out of time on this show.
Thanks for watching. More news and updates continue on the other side.